Good evening, everybody. A nice, cool fall evening. Some people wanted me to do kind of a quick overview of what our 2-day or our full day training will be this weekend. Some people were worried that, or wondering if they didn't have too much background on options, whether this would be good for them. And the answer is yes, because we go through all the elements of options, what the call and put considerations are when you're doing those trades, and then also when is the best time length for each trade. I use a kind of a criteria that it's 3 to 4 weeks, a lot of time left in the price move. I'll use straight calls or puts. Getting into a 2 to 3 week time frame, I'm more apt to look at debit spreads, and if it's right down to the final week, I'm going into a credit spread. So when I mention spreads to a lot of people, they say, "Oh, they seem too confusing." A spread is very simple. I'll go through this real quick as far as showing the logic and the math. But a spread is essentially buying one set of options at one price and selling another set of options at the same time. What this does is puts less money or exposes less or puts less money exposed to the trade and uh, has a lot more benefits than buying calls or puts outright. So a lot of people do not make money on option trading because their first inclination, if they don't understand all the ramifications of an option trade, they say, "Oh, this stock's going up, I'm going to buy the calls, get better leverage." That's not normally the right situation. That's what we're going to go through this weekend. So the spreads is what we'll concentrate on, but more importantly, why we want to use spreads. First of all, there's less money exposed to market risk. The percent return is greatly enhanced at a much lower price move. You don't have to have a big as big a price move, and the break even is much lower. But every trade we put on, we've got one important element. What is the math that makes that trade worthwhile or not? So I guess this is just an illustration of would I be buying puts here? Not after a decent price move. Maybe I'm going to do spreads. Now the advantage we have for putting on an option trade using candlestick analysis is something that we've got built into the charts constantly. We've got a much higher probability of analyzing which direction that move is going to be, or is that the right word? Much more probability of analyzing the correct direction of a trade. We also have entry points that make the timeliness of the trade much more accurate, and what the magnitude of that trade will be. So just because an option or a stock is going up or going down, that doesn't necessarily mean you want to just buy the calls or buy the puts. Again, using a time frame. So we'll go through this step by step. But here's the reason that we want to use a spread. I use this kind of example because it's pretty clear to understand. But if a stock is trading at $50 and we can see the next target is likely $55, and we are buying the 50 calls for $2.50, well, if it hits our target at expiration, that $2.50 has now gone to $5, or we've got a $2.50 profit on that trade. or 100% gain. Now, if the stock is trading at $50 and we buy the calls for $2.50, the stock has to go to at least $52.50 for us to break even. So that means we've got a decent percentage move just to get up to our break-even level before we start making a profit. All right, so that's pretty much easy to understand. Now, the math of a spread gives you a much different perspective. Again, the stock's trading at 50. We think it's going to 55. Well, if we buy the 50 calls for $2.50 and we think that our target is 55, we can sell the 55 calls, let's say for $1. That means we had to pull $2.50 out of our pocket, but we're putting $1 back into our pocket. So our net on that trade is $1.50. Now, if we hit the target price of 55, now we can pull out $5 or a $3.50 gain, which means instead of us making 100% profit, we're now making 233% profit. And additionally, our break even has to go up to $1 or $51.50 because that's all we've got into that trade. So we're going to be going through why spreads, whether you're buying put spreads or call spreads, work much more effectively. And it's not a difficult process. I mean, it's just basically one click on most trading platforms. So we want to make the relative or analyze what the relevant decisions are. First of all, a lot of people ask, well, how long or how far out do you buy your options? And that's going to be based on each person's risk-reward factor. Obviously, the closer you are to the expiration, the less you're going to pay for those options. And the higher risk. The stock might not get to that level in that time frame. And then the strike price. We want to be in the money, at the money, out of the money. And we're going to go through all those decisions. And these are just kind of very simple decisions once you understand what the math is when you're making your option trade setup. If the stock trades above 55 several days before expiration, you close out the spreads even though you may pocket only $4 instead of $5. Carrie, that still is a function of what is the chart telling us. It's trading at 56.50. Now we look and say, all right, do we hang on to this? Our option is only at 4, and the reason it's not at 5 yet is because there's time premium built into both sides of that trade, those options. So now we have to make a decision. Is the chart telling us we're still going up, or at least not going down? Because if we've got, let's say hypothetically, 5 more trading days before we get to expiration, if it stays above 55, it's eventually going to start diminishing the time premium on both sides of that trade and getting us closer to a $5 price. Now, on the other hand, if it's trading at $4.65 at that level and there's still 5 more days of trading, now you make a decision and say, all right, I bought this for whatever, $2. Now it's at $4.65. I've got 5 more days to expiration. Do I want to hold on to something that's worth $4.65 to make another 35 cents? Or do I want to take my profits now and move that money to where it might have much bigger probability? So again, those are going to be the math calculations that we do. If you do a credit spread, can you just do one contract, or do you suggest more contracts? Cass, that's still up to each individual how many contracts they want to do. Sound is going in and out. That's not like me. So anyways, the amount of money you put in will also be a function of what is your comfort level. And I was telling people in the chat room today that you buy the amount of option position that you're comfortable with. Yeah, so each, so your contract numbers are that if you're buying one set of calls and selling another set of calls, they're the equal dollar amount, or not the equal dollar amount, equal number of contracts. So if I'm doing a spread with 5 contracts, that means I'm buying and selling 5 contracts, 10 contracts, same thing. Okay, so what we will also be looking at is what is the market doing? What is the market direction? Where is it? And how much time do we have if we see a good stock chart? Where do we think it will move over the next 2 weeks, 4 weeks, 6 weeks? So we kind of calculate what type of option trade we want to put on. So again, buying a spread versus straight out call position, we want to calculate what the math and the risk is. So when I'm doing a spread, if I'm doing a $5 spread, like buying the 50s, selling the 55s, I don't want to be paying any more than $2 for that spread. Obviously, a $10 spread, I don't want to be paying any more than $4. So the rationale or the rhetorical question is, well, isn't you pay $250, making 100% profit, isn't that good? Yeah, you got to remember what your risk reward is. You still have to be correct on your trade. You still have to worry about the bid-ask spread, not so much now with them doing the spread. And you got to worry about what the magnitude of the move is. So you still have risk, and to try to get a 50-50 exposure for a 50% or 100% return, I'd rather buy something where the probabilities are a little bit more favorable. So what we're going to analyze is when we analyze one of our patterns, what should we be doing as far as option strategy? Our option strategy might be completely different right here than it will be right here. We might be buying calls outright right here. Right in here, we might be adding a spread. Right here, we might be adding another spread. Or right here, we might be doing calls again and a spread combination. So there's going to be different levels of knowing what the expectation is of a price move, of what strategy we want to put on at any one time. If one leg of a spread is in the money, are you able to close one? Oh boy. Well, remember, if you're buying one side and you're selling the other side, if you're closing one side, especially the buy side, that means you're naked on the sell side, which is going to what do I want to say? Really move your margin requirement drastically depending on the brokerage firm you're working with. On the other hand, a lot of people say, well, if you see something moving and it's moving greater than you think, can you sell one side? I usually don't. If my strategy was a spread at some point, that's going to be my strategy. If the price keeps moving, now I've got decisions to make. Do I want to close a spread and buy calls outright? I don't want to change my strategy midstream. So there's going to be a timing element. I might have different strategy buying right here, expecting a J-hook pattern, versus another strategy right here once that pattern is moving. So these are going to be kind of the considerations that we go through, because if we can calculate based upon our J-hook pattern that wave 1 and wave 3 is the same, maybe we're much better off right here buying a call and then doing an out-of-the-money spread up here, which means if this does move to the magnitude we expect, our call is going to make money, and the spread that we did up here, which we had very little money in, now has a big, huge percentage move. So for example, let's say we bought calls here, and I can't see the numbers, but let's say we bought calls here, and we paid $2.30 for them. And at the same time, we did a spread up here that we only had 40 cents in it. But if it moves through that level, maybe that 40 cents turns into $2.50. So you've got huge percentage possibilities when you have the right trade on. So everything we do is based upon a price move expectations, but this is our most important consideration. What is the math when you put on this trade? Will you cover risk management and exits? Yes, Bill, that's just like anything else. A lot of people say, well, how do you put a stop loss on your option trade? You don't. The options are just pieces of paper that says you control the underlying trading entity. So you were buying a strategy based upon the underlying entity moving in the direction that you expect it to. When the underlying stock moves in an opposite direction, you can say, or you can put in contingency orders that said if this stock I bought at 50 and it's now at 53, but if it comes back through 52, I want to close out my option trade. That's a contingency order, which they will do for you, provided you can't sit there and trade it yourself. Because the disadvantage is, if those options at that time were bidding, I want to say $3 and asking $3.50, maybe if you were sitting there, you could get out at $3.25 or $3.20. But if you weren't sitting there in this contingency order, they're more than likely going to get you out at the bid side at $3. Yeah, so that's going to be billed. That's all going to be built in. If you buy and sell commodities rather than equities, do you think of options differently? Perry, I trade commodities all the time. I very rarely do the options, only because I've got enough to trade as it is. But it is a good consideration, whereas the risk reward is on an option, you can only lose the amount of money that you put in. Whereas if you're buying a commodity and it all of a sudden slams against you, you can lose more than what your margin was to get in it. What is the risk assignment on debit spreads? I think it's different on each in each firm. But if you're buying a 50 and selling a 55, there is no risk assignment to it, because if you're buying it for $2.30 per option, you've already put the money in it. So the maximum you're going to lose is the $2.30. Many timey the options get far ahead of the underlying, and a stop on the option will capture that extra. Any timey the option gets far ahead of underlying, and a stop of the option will capture that extra yeah, I don't, many times, many times the option gets far ahead of the underlying, and they stop on the option will capture that extra time premium. Yes, but that stop also is going to be based on the price of the stock. That's up to each individual. I usually trade anywhere from 2 to 4 weeks out. Now, if you want to be more conservative, you can go out 1 month, 2 months. Now, but the reason I stay anywhere from 2 to 4 weeks is what is the function of the candlestick signals? It's telling you what's going on in investor sentiment right now. So we want to take advantage of that information of the price move right now. So we don't know what will be happening 1 or 2, 3 months further out. So that's the decision we can make is how far out do we want to go? Do we want to trade something that's only got 3 trading days, 10 trading days, 17? You can make that decision by what they call the ladder of how far out. Yes, and the further out you go, the option's going to be more expensive because you've got that time premium built in there. You've got more time for that price to move in the direction that you expect it to. So we also are going to work on buying a bullish spread versus selling a put spread. Selling a put spread is still bullish, but there's a lot of times where your risk reward and your rate of return is going to be more beneficial selling a put spread. Some traders buy calls for long, at least 1 month out for swing trades. You don't seem to use that strategy. What is the pros? Carrie, it's still up to each individual what their risk reward is. Some people would rather buy in the money calls because it's less risky. Obviously, if you're buying out of the money, you're putting in less money, but the price of that stock has to move up just to get to the level that of your calls to make a profit. So that's all the things that we're going to be going through is what is your risk tolerance? Where do we think a price is moving to, and how long will it take to get there? And so how far out do we want to go? And again, that becomes not each person, let's put it this way, there is not an optimal trading system for everybody. It's what you feel comfortable with. So I might be doing a spread that might be 10 days out. Somebody else might be much more comfortable with doing a spread that's 20 days out. Or buying calls that expire in 2 weeks where somebody else might want to buy calls that expire in 6 weeks. Again, it's all up to each individual's self comfort levels, self-risk reward. Are you always looking to end the trade around the expiration date, or can you consider ending the trade before expiration? What is the advantage? On a spread, it's just like anything else. You're buying based upon what the price is that they can get for you that day. Now, if the price of the stock goes up, obviously, it should be working in your favor. And the closer you get to expiration is when you're going to maximize your profit on that trade. So if the maximum you can make for a trade of 50, buying at 50, selling at 55 is $5, on expiration day, if the stock is trading above 55, the difference without any premium left on either side should be $5. Now, the disadvantage is, let's say you bought a spread right here. I'm getting way off track. But let's say you bought a spread right here for $1.80, thinking it's going to go to $5. Then all of a sudden, it skyrockets up here. Well, both sides are going to move. You might be sitting hoping that it stays up here for the next 2 weeks, expiration, because it might be trading at $1.70 because one side's moving faster than the other. I never have time to do this. Buy the cheap implied volatility call and sell the expensive implied volatility call to get more bang for the buck. Tom, you can basically do any strategy that you want. The underlying factor to what strategy you're going to use is knowing what should we expect coming out of a candlestick pattern. We know that the classic pattern is a fry pan bottom, whoops, followed by a J-hook. So what do we know about our J-hook pattern? That this wave right here and this wave right here will be the same. So now, depending on what type of strategy you like doing the best, at least you know the direction so you can put that strategy or the strategy that works best for you on. Can you day trade a spread? Very rarely. If you're going to day trade something, yeah, the spread, because you don't have any control of the spread. Meaning, if all of a sudden that stock price the next day you bought it for $1.80 shoots up here, it might not move very much because both sides are moving at the same speed. Whereas if you just bought the calls here and it went up, obviously you've got a good profit in the calls. No, just an example. Whoops. So again, the advantage we have is we know the direction of the move with a high degree of probability, the timeliness of the move, we can see where the pattern is likely to break out, and the magnitude of the move. Now, does that always work? As far as the magnitude of the move, definitely not, but at least we've got a gauge or a target to look or expect to make our decision before that trade's put on. So again, we got less money exposed to the market. The percentage return is greatly enhanced at a much lower price. And the break even is much lower. The market is closed. Oh, Jason, no, he was asking whether this was a current chart. So if we've got something like what we saw today in Amazon, we could expect a pattern setup. In this case, when they gapped it down from a bullish candle and it opened lower today, what were we expecting immediately? A bearish flutter kicker signal. That told us if you wanted to go after something, you could buy the calls. Or if it's heading down and you think it's going lower, maybe you bought the calls. I'm sorry, the puts. Said that wrong. Bought the puts, and if it starts heading down and it's going in the direction you think, now you can add some spreads to it. The trick with options is predicting the direction of the stock. If the stock price languishes or doesn't move at all, then you will end up with a small gain or loss equal to the price you paid for the spread. Exactly. But that's the whole point of us trading based upon the candlestick signals is we're anticipating a strong price move one way or the other. So if we can see a bearish flutter kicker setting up, at least we have a strategy now, knowing that if they open this lower after this setup, we know we have a bearish flutter kicker signal. That allows you to be much more aggressive and move faster as far as putting on a trade because we know what should happen after a doji. It's going to move in the direction of how they open it after the doji, especially with stochastics heading down. On the other hand, if we can recognize our bullish patterns and knowing that it opened positive in this direction, now we can say to ourselves, if it opens up and starts trading up in this range, what do we expect? We expect a J-hook pattern. Now we can get prepared to decide what would be the best strategy at this point. But that is based upon the individual stock price. Today, a couple people were asking, well, should we think about buying the calls here? But there's another factor that you have to take into consideration. And that factor is, where is the market? Right here. If the market's turning over, we see stocks turning over, we'll probably have a completely different option trading strategy at these levels than we will at these levels. And then we'll probably have a different options trading strategy right in here, and then another one right here. So another consideration that you have to take into account is, let me see if I get, we might have a completely different strategy right here, knowing that we don't have a full-fledged reversal than we would right over here, where we do have a full-fledged reversal. So today, when in the options room where we had a couple people asking, well, should we be buying calls on, I think, one of the ones we were looking at, and the answer was no, because where are we in the overall market? We're in the overbought area. We're a good distance away from the T-line, and we're going to go through this a little bit more detail when I go to the live charts. And what is this the best place to be buying calls? Probably not. At worst, you might want to look at some strata or puts, not put strategies, call spreads, because of our risk reward that we're already up here pretty high. So depending on where you are in the market makes the first step of your analysis the important one. Where are you? And again, what would we be looking at buying 4 weeks out or 2 weeks out? What is the market telling us? So anyways, this was just kind of a prelude to what we're going to go through. And the underlying factor, again, to any option strategy is the first phase of that process, which is what is the market telling us and what is the strong bullish or bearish charts that we want to go after. Once we realize that, that is where we can start making the best option strategy decisions. So if you're a non-member, join us Saturday. We always advertise that it's going to be a full day, or usually from 10 to 2. But as people have experienced, that's a laugh. Usually it's 3:30 to 4 o'clock before we're done. But the one thing I always kind of hopefully emphasize, or modus operandi, is when you walk away from one of these sessions, it's not like, here's the information, I hope you learned it. We don't close down the session until everybody fully understands what they're looking at. So, and again, spreads are going to be part of that process. So, back to, it's $297 for non-members and $197 discount price to members. So here's our tricky marketing concept. Join as a member for $97. Then you get the $197 price, and at least that way you get 30 days at least of using the candlestick chat rooms and the picks and the special trainings we do on during the week. And then after 30 days, if it doesn't tickle your fancy, Yeah, you still got 30 days of exposure. Amazon is down 96 and change after hours. Earnings, yes, that was earnings. But you have to predict that. You have to predict what, JQ. I signed up and look forward to becoming an options master. Kathy, you will become an options master. Okay, so let's take a gander at what we were looking at, responding to Magic's comment. Okay. You're suggesting if a stock doesn't move at all, is a strategy dependent on the stock market direction? Can you predict sideways? Oh, you can. But that's kind of working backwards for what candlestick analysis does. Because candlestick analysis is something that's going to show you when there's going to be a new change of price movement. So there's like tons of things you can do to see whether a stock's not moving one way or the other. Okay, let's see what I've got here for. Okay, so here is something that should be pointed out, or at least done as a visual analysis of, look what happened yesterday in the Dow. Shooting star in the overbought area, decent distance away from the T-line. Today they gapped it up again, and at one time the Dow was trading up almost 500 points. But what was the advantage that we could ascertain when it was trading right back in here, even though it was up 350 points? What were we looking at? We were looking at another shooting star, and then it started trading off near the end of the day. Mark, that's exactly right. As a matter of fact, I had a buddy of mine who was a financial genius write up a strategy. This was way back in the 80s. That is now known as a collar, but I'll find a chart that is dismal and show how that works. But it would be buying it'd be selling a call spread way out of the money. And then it would be selling a put spread way out of the money, which in both cases, you're putting money in your pocket. And as long as the price didn't fluctuate to that magnitude either direction, you kept that money in your pocket. So if you have a slow-moving stock, and I'm afraid this is probably not a good example right now, somewhat, like on Microsoft, that it might be selling a spread up here and selling a spread down here, as long as it stays in the, oh, darn, can't think of the word. Yeah, they'd be credit spreads. Two deviation, 3D. I think Bollinger Bands are 2 deviation. It would go out to 3 deviations. So very little possibility of it going through one of those upper limit or lower limit. Yeah, so I think they call them iron condors now, but when I was doing them, we didn't have a name for them back then. Anyways, here's what I want to kind of illustrate is having a much better perspective of what was going on up here. And so early this morning, we were having people ask whether they could be buying calls on good bullish stocks. And the answer was, I would kind of wait because of our indicators that tell us this is probably not the right time to be buying. So when it was trading up here, make this bigger, look where it was compared to the T-line. That's always a warning, especially up here in the overbought area. But what was even more of a warning was notice what happened in the NASDAQ yesterday. It opened and closed down here. Even though it traded up for the day, it opened and closed down here, below the previous day's open. We always illustrate the fact that if you see an uptrend and they're gapping down below the previous day's open, even though you're still above the T-line, you probably want to start closing out, whether that's a stock position or if you're trading stocks that are related to that index, like the high techs, that's telling you that's not a bullish sign. You want to start getting ready to close things out. And then on top of that, we know that if it opens lower and starts trading lower, what do we got going on? There's our bearish flutter kicker signal. What's a bearish flutter kicker signal? It's basically a kicker signal that if you took out this little flutter, you've got your strongest reversal signal. So you had that, and then all in a matter of 10 seconds, you can see what's happening at the S&P 500. Yesterday it did a shooting star harami failure at the 50. What did that tell us? We better see it trade positive today. Well, when it started trading back lower, now what type of signal do we have up here in the overbought area? There's our evening star signal. And is it relevant? Definitely. It's doing it right at a level everybody was watching. So what do we do tomorrow? Well, if the markets open up lower tomorrow, that's pretty much telling us they're not going up anymore. They're starting to head back down. So how can you tell whether they're going to open up or down? Whoops, that is not the right time frame. You can see what's happening on the futures. Well, right now it's showing the Dow open, if we are looking at this right now, trading a little bit lower. And I imagine the same scenario on the S&P 500, except the S&P 500 looks like it's come right back up. At one time, they were trading down here. After we saw Apple took a nosedive, but I think it's back up to about where it closed. And same thing with Amazon. Amazon was down, how many, 93? Where is it trading right now? I could probably find that over here on this is regular hours. This is after hours. So it's trading down here after hours. I think Apple, whoops. Whoops, Apple's actually come up to where it's trading above where it closed. But in both cases, they were selling it off, even though Apple, I think, had slightly positive earnings. What's a good option strategy to play through earnings? You might use a spread just to mitigate your risk a little bit. It is overbought on the daily time frame. What about the weekly? How do you handle? It depends on your time frame that you're trading. If you're trading longer term, All right, maybe you're going to stay in something on a daily or on a weekly. But obviously, the daily chart, so there's the weekly on Amazon. The daily chart is telling you exactly what's going on. So I'm usually oriented toward the daily chart because I'm a swing trader. My trades usually last anywhere from 2 to 10 trading days. So I'm not holding something longer term. Now, another element of using options is if you're holding something long term, let me see if I can figure out. If you are holding something long term that you wanted to hold Apple for long term, but you can see it's having a hard time moving up, but you don't want to sell it, that's where you can use some of your option strategies to write calls against your positions. Straddles are, yeah, what is it? The strangle is where it's staying in between the trades. The straddle is you're hoping for a big price move. So let's say you didn't know whether Apple or Amazon was going to have a big move to the downside or a big move to the upside. It means you might want to do a call spread up here and a put spread down here, so that if it did move big, one of those was going to make a big profit for you. Why don't you say you use Bollinger Bands? That's your ticket to ride for a credit spread, is it? JB, you can use whatever you want to. A lot of people say, well, do you use Fibonacci? No, I don't use Fibonacci. But if I saw something moving and I saw it starting to head up, where might be my targets? Well, the moving averages. Or I can come over here and say, let's put a Fibonacci retracement on here. Oh, hold on. Just blinked my contact lens out again. So if I put my Fibonacci numbers on here, I'll get rid of that. Now at least I can watch to see what everybody else might be watching. I don't use them to make my decisions. I just use them to see what's hold on. So that was a long answer to say, put whatever you think would be useful. Bollinger Bands, Fibonacci numbers, trend lines, anything that you can use to see what everybody else is looking at, to see if you see a signal occurring at one of those levels. Mark, unfortunately, I can't do eyeglasses because I've got such stigmatisms that I have to wear contacts just to smooth out the front of my eye. Okay, so also wanted to point out, again, that in a matter of 10 seconds, you can look at the Dow, the NASDAQ, the S&P 500, and the transportation index, all giving you kind of probabilities of which direction things might be moving. Now, today, it looks almost like you hit a tweezer top up here, but still have the same scenario. If this opens lower tomorrow, what do you think the first target's going to be? Well, remember, when they come up through a resistance level, they'll usually pull back to see if that resistance level is going to act as support. Number one. Number two, look where this moved to. Fill in the gaps over here. And where are you stochastics-wise? At a point where you see selling, stochastics is going to start turning lower again. So when do you take profits? Well, you can see there was some selling over here in the oil stocks. They had been acting pretty well. So now we're starting to get more of an indication that if they start opening these lower tomorrow, we'll close out the position. But we've got an extra indicator. We can see what oil is doing. Well, as you can see right now, oil is in kind of a slow uptrend, but basically telling you that oil prices aren't heading lower. They're probably not heading higher, so they might be just waffling in here for a while, which also gives us being able to analyze what they're doing, see what signals are being created. Today, Apache did a dark cloud signal. ExxonMobil, not quite a shooting star, but showing some weakness. So you can run through these stocks. Occidental did a dark cloud. So we know if things open up weaker in the oil stocks, probably time to be taking profits. Just a much better visual analysis now I was going to say, if you wanted to hold on to these stocks, you might do write some calls against your position if you own the stocks. What was it? Oh, AutoZone. This is why identifying kind of your patterns. Notice where AutoZone broke out. Right there at the beginning of a kind of a big fry pan bottom. Why is that important to us? Because what do we expect coming out of a fry pan bottom? A strong price move. And what usually indicates that strong price move? A strong gap up through that resistance level. Same reason we recommended CC. Nice fry pan bottom, and where did it break out? Right there at the breakout level. What is our expectation? You stay long on this as long as it stays above the T line. So same scenario here. If you've gotten up to a level that becomes obvious of where the selling may have started, I think this was a bearish engulfing. What are the other elements that we can see that would kind of confirm that this was a bearish engulfing? Right here at the 50, right here at this level. If this opens lower tomorrow, you probably want to start shorting it. Or additional confirmation was Micron selling off. So if you can see that there's other stocks in the same sector being sold, that usually means they're selling off the whole sector. You can see what happened here in Advanced Micro. They opened it up positive, sold it off. Probably indicates if they open this lower, it can be shorted. Yeah, kind of your fry pan bottom breakout with a trend kicker signal. Where else did I see a trend kicker signal? Honeywell. Notice where this broke out. Notice your trend kicker signal. Remember, a trend kicker signal is you're already in an uptrend, then they have a bearish day, opens here, closes here, then they gap it back up. What's that tell you about your fry pan bottom? There's still a lot more upside. ACGL, there's your trend kicker signal. Kind of a breakout level. You could draw pretty much a line right up through the tops. Let's see, we did those. Netflix. Here's your breakout. Make this big enough. Where did it break out? Right about that level. What do we expect after a breakout? 45 degree. So this is another situation we'll look at as far as option strategy. What would be the best strategy here? We don't know whether it's going to go like this or like this. So maybe the best strategy would be putting on a spread here. How is your trading decision affected by what others are doing? Price move of moving average 15 minutes. Why should we pay attention to what others are doing? Because if you see a good chart, you see a good chart right here. Say, well, it's breaking out. That's good. But is this a renegade stock in a sector? Or can we see other stocks in that sector also breaking out? Well, if they are also breaking out, what's it tell us? It tells us they're being bought across the board. So what do we want to do to make sure our probabilities are much greater in our favor? That we're buying a stock that it's in a sector that everybody else is likely buying. Oh, ExxonMobil's earnings are tomorrow. I'm thinking, who announced today? Oh, Valero. They were, yes, politicians were complaining that Valero had record earnings. Oh, that's moving in the right direction. All right, so things like Shopify reported earnings today and broke out nicely. We're in the overbought area. Should we be buying this stock? We can see the fry pan bottom. We can see where it broke out, right smack dab at the 50 on good earnings. If the market isn't falling out of bed tomorrow, what can we kind of expect? Maybe a 45 degree off of here. I had written down a few today. So this is one that Marshall pointed out for us. Again, this is what I call observe the obvious. Look at your big bullish, I think it was just made it to being a bullish engulfing, right smack dab off the 200 in the oversold area. Coming up, you could still be buying this one on positive trading tomorrow. So this has all the makings of a good bullish trade. A big bullish engulfing off of moving averages, moving average that everybody else is watching. A doji sandwich type setup. You can buy this one on positive trading. Nova, kind of your cradle pattern. And a bullish day above the T-line. What did it tell you about your downtrend? Pretty much been broken. Look for more upside. There are lots of indications that tell you likely what the smart money or the money in the know thinks about what's going to happen on earnings. So they were selling this off today, going into earnings. That told us that more than likely the probabilities are pretty strong that the earnings aren't going to be good. Now, is that the case all the time? There was something. Darn. There was something where there wasn't any indication of what could happen. Maybe it was Shopify. Yes, Shopify. there wasn't any indication one way or the other of what the earnings were going to be. So you probably don't want to be trading that, or if you're in it, you probably don't want to be in it. However, now this information tells you with much more clarity what you want to be doing after earnings. Oh, Meta was the same thing, except here was a case that I was illustrating earlier today. Notice you were in an uptrend, and then look where they opened and closed it yesterday, at the low or just below the open of the previous day. That tells you if you were long, you want to be out of this immediately for two reasons. Because obviously, it's not very bullish to have it gap down below the previous day's open, number one. And number two, look where it was closing, back below the T-line. When it does something like that, it's basically telling you be out of the trade. Because at that point, if you were hoping for it to go up, that's the only thing you would be your strategy. You were hoping it was going up. Everything else was telling you wanted to be out of that trade. PRG, that's a scoop pattern. You can see the flat handle and the scoop. And how did your scoop start? With a best friend, cradle type pattern. This one you can be buying on positive trading. Why? Because what do we expect coming out of a scoop pattern? A slingshot effect to the upside. And QDEL, another great chart setup, because look where your J-hook pattern supported, right off the 50, off the T-line, now heading up. What would you do with this one tomorrow? Your T-line rule. If it opens positive, it's probably trading positive. If it's open lower, you don't want to do anything with it. MAC was the same situation. Wave 1, wave 2, right at the 50. Where do you think wave 3 could possibly take you? All the way up to the 200. QDEL earnings November 2nd. All right. That's still a good fur piece away. CNK was a product of your McMuffin. Morningstar signal followed by a doji sandwich. Now a shooting star type signal. What would be the trading strategy here? If it opened lower, it's probably coming back to test the T-line. It needs to open positive and trade positive. We did that. We did that. We did that. Oh. And there's kind of your bullish flutter kicker signal on FANG. That's the bullish or the bearish? Inverse, bearish. So you've got a bullish flutter kicker on the FANG stocks. That's implying there's more upside. Yes, McDonald's. McDonald's would have been a toughie that if you had been long, might have a hard time holding on to it right there. But now they've gapped up. So if you're long, what's your strategy? You stay long, but you have to have a safety stop at today's open. HZO, kind of a scoop pattern breakout. What's your strategy here? The doji rule. If it opens positive, you can start buying this one. Oh, for crying out loud. Maybe that one was too small for Chipotle. There's your bearish kicker signal. Gap down. Now you're right here at the support area. If it opens lower tomorrow, what can we anticipate? Wave 1, wave 2, wave 3. So that, if I was looking at this, obviously I wouldn't want to short the stock at 1468, but I'll take a look at the puts or put spreads, which now I have to kind of say I did look at the put spreads. You would have thought something like Chipotle would have big volume in the options. There wasn't enough volume to do a good bearish spread. GTN, same scenario. Wave 1, wave 2, doji, 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 bearish engulfing. You could be looking to short this one on weakness tomorrow. Oh. Bearish kicker signal, or not bearish kicker signal, bearish best friend. So this at least gives you an alert to say if this starts trading lower, especially if it comes back down through the 200, you can be buying or shorting that one. So the benefit of knowing what the strong signals are, especially with gap downs, here's Cleveland Cliffs, a bearish Harami failure right at the 50, gap down, came back up, failed at the T-line. What would be the next expectation? Wave 1, wave 2, going into wave 3. And just a couple more. The bigger the signal, the more compelling there's been a drastic change of investor sentiment. Now what do? This opens lower, at least expect your next target being the 200-day moving average. Crown, bearish best friend. And now if the market is rolling over, this has a strong move to the downside, that gives you that much more evidence that the bears are going to maintain control on this one. Oh, put this in the wrong place. But Cheesecake Factory. Look what's happening to this one. A bullish doji sandwich, bobble breakout. High probability there's going to be more upside on this one, which was kind of the same scenario with this one doing a J-hook pattern, supporting right smack dab off the 50, right where you can see where the support will be. Twitter is going private. Oh, Twitter. Boy. Mr. Marabuzzo, I would say, what is your upside potential on this one? Another 40 cents. If I had a good profit in it at this point, I had to go find something that has better prospects to it. So the problem with trying to hold out for the last dollar, for the last penny, let's see, you'd be 40, 54, you're 50 cents away. I would take my money and run because you can never tell what might happen tomorrow. Elon might come back out and say, well, wait, he's going to hold off. He still has to get something straightened out. Now it's back down to 52.10. So I would just take the money and go. But that's me, because I think there's plenty of other opportunities to make money out there right now than hoping for another 50 cents. All right, still too close to say, why do I want to squeak out another 50 cents when I might be able to take that money and go find something better. Okay, so there are plenty of ways to use options to maximize your profitability based upon knowing what a pattern is likely to do after a breakout. 45 degree. Might have done a 285, 290 spread on this one. Okay, thank you, Jay. So anyways, that's what we're going to be doing Saturday. Saturday is going to be cold and rainy. You might as well just stay in your pajamas, bring your hot cocoa, and get a lot of insights as to how to use the correct leverage and the correct trading strategies for the appropriate candlestick signal expectations. So with that, is there any general questions on candlesticks? Okay, thank you, Jay. That's the nice thing about having a chat room where everybody is kind of watching the same things that you might not look up or be aware of as far as information going on. Somebody can provide that information. I think we usually have about 150 people in the main chat room and about 20 in the options chat room. So it's a good place to be asking questions if you need clarification as far as signals and patterns. Can I get the recording? Yes. Jim will have that available. All right, I guess with that, Jim, let's go ahead and do the double line. And in 3.7 seconds, let's do the next double line. Whoops. You stay long on this. You can see the big left-right combo down here. You're in the overbought area. You suspect it could get here or even fill the gap here. But remember, depending on the market conditions, you want to see what happens as far as a signal. The corporate bond index came up nicely. Now you want to see what it does here at the 50-day moving average. That's a nice J-hook pattern. I would stay long on this one. Walmart did a tweezer top. If you're, it's kind of a fry pan bottom, but you've done a tweezer top right there. I'd be ready to take some profits if they open this lower tomorrow, which means they're probably heading back to the T-line. This one you stay long, but same scenario. You're doing kind of a doji up here where it topped out before. If I was long, I'd have a safety stop at today's low. Whoops. Gap up and over. Bought conditions with wave 3 having some height as wave 1 sell immediately trades. Oops, you were ahead of me, Carrie. Yes. If I had just read what you said, I could have told you what to do. Oh, boy. Long at 320. Sell calls now or sell stock outright? I would sell stock outright. that look like to you? It's like a wedge. Failure at the 50. I would close this one out. MMI, you stay long. I'd still use the 50 and the T-line as a stop. Oracle. Stay long. I'd probably use the halfway point of this candle as a stop. Because if it came down through there, it was failing at the 50, right about the same level it topped out before. UAVS. Stay long. You can be buying this if it opens positive tomorrow. Starts trading positive. Oops, how did I do that? Slumberger. Whoops. Another one that I would take profits on a lower open tomorrow. Now you'll have a little bit of head start on two indications tomorrow. One, if the markets are starting to open lower, let's say you saw it's opening down and after your shooting star, and especially on your NASDAQ, if that's opening lower also, and your crude oil prices are starting to back off tomorrow, that's all quick indication to say, all right, they're probably going to be selling off the oils again today. Let's take some profits. Here, just stay long. Watch to see what it does at the 50. IART, that's kind of your doji sandwich trend kicker. Stay long on that. That's a good strong chart. MMTV, just stay long as this stays above the T line. Cisco, that one's another indication that you might be getting some weakness. If this opens lower, I would suspect it's coming back to test the 50 and the T line. Rugger, stay long, kind of your fry pan bottom, and also I think the Japanese is your inverse head and shoulders, which I think the Japanese rice traders called the three valleys. Valley 1, Valley 2, Valley 3. Myra, another one that I would close out if it opens lower tomorrow. Telling you they're not coming up through this level. Halliburton should be strong, like not quite a dark cloud. Needed to close halfway down, but I would still be ready to take profits if this one opened lower tomorrow. Fuel cell, not anything to get excited about. Even though it started up, it still has to fight this downtrend. This is why the 34 is relatively effective. If this opened lower tomorrow, I'd probably close it out and find something better. Let's see, Pfizer, same scenario. A lower open says they're coming back to test the support level of the 50. And TZA, stay short. Stay short. Nothing yet to tell you it's turned around. Texas Instruments was what I was looking for because it did that big belt hold type signal yesterday, came right back up to the T-line. However, when they opened up positive and sold it off, I would be ready to short this one. It wouldn't be the best short, but I'd rather be short this one if it opened lower, telling you this downtrending channel is still working. McCormick, doji sandwich. Stay long. Just watch. You're running out of steam on your stochastics. Watch to see if it hits the 50. And advanced micro, nothing. Really didn't confirm. It would have confirmed had it opened positive and traded positive on yesterday, but it opened down here. Gap back up. Had the indication that it might be turning up, but now you got kind of an evening star signal. I'd be ready to short this one on weakness. Yes, failure at the 50. Netflix, we did. Be ready to take profits if this starts trading lower tomorrow because of the tweezer top today. And UPS, if it starts trading lower, I wouldn't be long. You could be going short because of the things rolling over, but it might not be a real powerful short. TRN, now you watch to see what it does from here. Where did it move to? Right smack dab to the 200-day moving average. So now you have to see what they do from this level. Oh, okay. Will you get the link for this webinar today? I missed it. Oh, for this webinar, Michael, it'll be out. Jim will put it out for you. Is this a symbol? YPF. Just stay long. So you see a sell signal. John, uh, then let's see. This one's not coming up. BKR. There it is. Not a real fry pan bottom breakout. That's just kind of your J hook pattern, but it is a breakout. So anticipate the 45 degree. Good chart. Another bullish confirmation is the fact that they came right down to the T-line and traded back up. What's a belt hold? A belt hold signal is where they gap it way down out of the trading range and then bring it back up into the trading range. The Japanese rice traders say two wrestlers were wrestling. One is trying to back out of the ring. The other one grabs his belt and pulls him back in, and they're back to fighting again, which usually indicates that they've taken out a lot of sellers. Now there's less sellers in the way, so you look for bullish confirmation. You could short advanced micro on weakness. And NVIDIA had a hard time staying up today. They gapped it up right to the 50 and sold it off. So now you have to watch to see if they continue to sell it back to the T-line. Fastenal. That's a nothing chart. wouldn't be long or short. There's nothing on there to make you want to go long or short. FedEx, same scenario. That's kind of a nothing chart. You're still sideways. Home Depot. You can stay long on this. Not very compelling, but it's in the right direction. And Sedge was another McMuffin. Here's kind of your Morningstar signal, doji sandwich. You stay long until you see a sell signal. Okay. All right. One last one, Sava. Nothing yet. You can see that it's holding up above the 50, but it's having a hard time getting through the T-line. So it wouldn't be long or short. All right, everybody. Takes a lot of strength to pick up a sumo here. Oh, you don't pick them up. You just grab his belt and you pull him back into the ring. All right, everybody. We'll see you bright and early tomorrow in the chat rooms. We'll see you then.